Okay, everyone, welcome back to another episode of Line Your Own Pockets. We got another user question. And funny enough, before we get into what it is, I think it was like 3 weeks ago, Dave proposed this to me of what do you think of this? And both of us probably have incomplete answers, but we haven't, I don't know if we haven't decided on an answer, or we haven't decided on the best way to articulate an answer, but it's been one of those kind of noodle scratchers that I've caught myself thinking about a little bit. So I think it'll be a really good episode because I think what we're gonna do is we're just gonna bounce the potential answer off each other, and then probably by the end of it come to either a disagreement or an agreement. I think either way it'll be super fun. So, Dave, why don't
Yeah.
you go over what this user brought to you and why it's so complicated for us?
Yeah, so this came from a new trader I'm coaching now. We started up a couple months ago. Really sharp guy. Like his name's Tyler. A lot of people that come to me, like they seem to have a lot of success in some other area and they come to trading now.
Mm-hmm.
Um, and I like people like that because they're super smart and they're motivated. They know they can do it and they're just fun to work with. So Tyler asked this question, and I'm just go ahead and read it here, and then I'll tell you what I thought as soon as he asked me. So he said, "Okay, Dave, at a high level for the trading edge, for trading edge in general, if
Mm-hmm.
something is working year to date way better than previous back tests, why do I care what it did years ago?" So he's basically saying, hey, I've got a back test. It looks great in this year. So it's been like 4 months, or at this point, I think it was probably 3 months into the year.
Mm-hmm.
Looks great for this year. But when you go back further back in time, it doesn't look good. But why does he care? Like, what does it matter? Like, the last 3 months are great. So the first thing I thought was, okay, I sort of answered this for myself many, many years ago, and I haven't really thought about it in a long time. So it kinda took me aback when he asked it, and I didn't have an immediate answer that I could just copy and paste essentially
Mm-hmm.
out of my brain. Uh, I thought it was just a great question because of that, the way I felt when he asked it and what I thought about. And then, I knew it'd make for a good podcast episode because when I mentioned this to you, you were basically like, "Hey, let's don't talk about it until now. Like, let's
Mm-hmm.
wait and record it because it's gonna be such a good topic to discuss," I think.
Yeah, and I think this is another one of those two that will show the difference between day trading and swing trading a little bit, like long-term trading and short-term trading. But the reason that I think my brain just started kind of circularly thinking about it is that the two schools of thoughts, the two things that came to my brain right away was one, you don't have enough data to robustly test across different market environments whether your system kind of works over that short a time frame. The other thing was, well, maybe you found something that is a relatively new phenomenon, and that you're just getting right now, and in which case, right, and you have to, and I think this might be one of those kind of intuition or type of things, but because if you've, say, discovered something that's a new phenomenon in the market, that's something that happens just now in the market and didn't happen a couple of years ago. One example is I know a guy who's running these double and leverage triple ETF strategies. These are fairly new, right? They're in the last couple of years, for individual stocks they've started existing. So if you found an edge there, that's great. But what you're kind of saying is that at least in the past, you're able to test this edge and it doesn't work. So I don't, and again, it ends up circling around my head over and over again. Is that you want as much data as you can to be able to test and to optimize and to do all that kind of stuff. But at the same time, what if this thing just started working right now and will continue to work in the future? So yeah, this is why this got me pretty stumped. So I'm excited just to kind of go back and forth
Yeah.
with you on it, I think.
Yeah, so this goes to the core of trading for me. Like,
Hmm.
this question goes to the core, and Because like I've said many times on this podcast, I want traders to have a path to confidence. And that's what I work with traders to create. And if you, what do I mean by that? It's easy to trade with small size when the size doesn't matter. Trading is easy. Like it doesn't
Mhm.
really matter, right?
Yeah.
If you're trading small size. But you should be on a path to trading with bigger size. And you should always have in your mind questions that you need to answer to get to bigger size. And like that doesn't happen overnight. You're going to have to gain some experience at the news at a higher size. You're going to have to, see how the strategy works. You're going to have to get acclimated to the new size. It's sort of like when you go to, like when I go skiing in the winter, it's high altitude, right?
Mhm.
Um, if you're not used to that altitude, you get a headache. I mean, you basically get sick, and if it's bad enough, you could get really sick.
Yeah.
So what we've started doing is staying at a lower elevation the first night, and then when we go skiing, the second day we go. So that first night allows us to get acclimated to the higher altitude. It's the same thing when you're trading with higher size. You have to sort of there's a period where you have to get yourself acclimated, just for a whole variety of reasons.
Yeah.
Um, but so why is this question so fundamental to that? If you're trading something now and it's worked well for 3 months, but the back test before that looks bad, well, it's giving you a signal. It's saying, okay, this has happened in the past. What's going to happen in the future when you're in a drawdown? What is going to be going through your mind?
Mhm.
That and the reason it's so fundamental is trading through drawdowns and having the confidence to trade through drawdowns is what makes traders successful. And
Yes.
that because that's when you quit. That like we talk a lot about how high a failure rate there is among traders.
Mhm.
The only time the reason that is because they can't trade through a drawdown because they don't have confidence in the strategy. Um,
Yeah, and I would go even further than that. Like it is I think it is everything in trading is how you deal with because I would and this from past experience, the kind of death cycle of trading is a little bit of a drawdown, going completely off script or sizing up or doing all these dumb things and just tanking the ship that way by having that drawdown not something that you can understand and from also from example, right? We came out of a pretty wild couple months there, and it'll be interesting to see if someone watches this back how tired I look then versus now because I've just gotten my account out of an equity drawdown and up pretty nicely on the year, and it's yeah the mental toll there is really high. So I totally get what you're saying that if you can't, for me it was very easy to go back and say let me look at the strategies during 2020. Let me look at them through 2008. Let me look at them through the year 2000 and say, okay, what's happening to me right now is perfectly in line with everything that had happened
yeah.
before. So I can muscle through. I can go through, and I know that even if it gets a little bit worse or a little bit better, then that's fine. But so that again makes total from a psychological point of view. But what about again the other side of that? What if the person has actually discovered something that is a new phenomenon in the market? So I guess that just comes to the question of how long must that phenomenon exist in order to give you enough understanding or enough confidence to then trade that because like the example of the buddy of mine who's doing this weird stuff with these 2x single stock ETFs or even better example, crypto traders, right? I'm building crypto strategies right now. Um, in 2018, there was no data, right? And that even now, I've only got about 5 years, 6 years of really good data. So I guess the more important thing is when is enough? Like, how much is enough? I think that's the question to answer, right?
Yeah, um, I think most traders. uh, base their answer to that question on too small of a time period.
Mm,
So, and just think about it. Like, yeah, you're suggesting that, hey, maybe there's something new here.
yeah.
Well, uh, if let's say it is, it's still too new for me to really have a path to confidence because, like, how do you know that it's going to last? The only way you know it's going to last is if you really, really, really understand the fundamentals of the market structure around what's happening and
Yeah.
you know that it's going to last. But that's so rare, a trading strategy that works like that and that you would have the insight to understand it. The real way to confidence is to see, okay, how long is this thing had a really good looking equity curve?
Hmm.
How many trades are behind that? How many markets does that cover? What are the worst drawdowns in it? And what are those going to feel like? That this is the main reason that the number one thing I look at, it's not the only thing, but the number one metric I look at is looking at the equity curve
Yeah.
to determine if the strategy is going to be successful because it tells such a vivid story about what you're going to be feeling when you trade this strategy. I
Hmm.
mean, look at the drawdowns. Those are pain, right? That is pain looking you in the eye. You're going to be miserable there, and you're going to wonder if this thing even works. Is it going to come out the other end? And like I said, that's why traders fail because they don't have the confidence when they're in a drawdown. How else would you know? Like, how else would you know if you're going to come out of drawdown? Just because somebody said this is a good strategy and that's why you trade it? That's not good enough.
Mm. Now, and again, I totally agree with, and I think we're probably doing an episode soon on what to optimize for, and I think that equity curve discussion will be something we'll dive into. But I totally agree there as well. Um, the the question still remains unanswered, Dave. Like again, so 3 months. That's okay. Now, assuming just based off one of your clients, this is a day trading strategy.
Yeah. Mhm.
Okay, so um, that to me is a little bit more interesting. If someone came on and said, "Hey, I got the swing trading strategy for the last 3 months," I'd tell them, "Get out of here!" Right? It's nothing, right? But the market's probably just either going up or down for the last 3 months, and you're lined up with that. But there has to be that moment in which you can be comfortable, and I think probably like with most things, the answer that we're both going to kind of land on is further testing is obviously required. So that is either in paper or small, right? So if I say I had a new strategy, if I was in this scenario and I had, my 4 or 5 strategies that are working and they're doing fine, and then I think I've discovered something, and the recent back test looks good, and I have some reason why I think that this change has taken place, right? I think that's the other thing is that if I just come across something and the whole back test sucks and now it works and I have no idea why, then it's nothing. But if I have some reason to believe that yes, there has been some fundamental shift in the market, or I've discovered a new asset class, or something that hasn't been around before. For me, the first thing I'm doing is I'm giving it a small account. I'm giving it like 10 grand or something, and I'm throwing it over there and I'm going to start forward testing, which I don't know. I never know why we call it forward testing. It's just watching it in real time. But that idea of gathering more data in that way. The other thing I think is to get just more, you know, psychological about it, and what I love about this market is I think it's just opened up another question is if you can find out why it's working now versus not working before, and there is an answer there because it could just be random noise. That might be more important than this entire discussion, because if there isn't something that flipped, but maybe the market's like right now in the last little bit, the market's insanely volatile. So maybe it's that. Maybe it's the way the market has been moving. So I think for talking directly to the person there, if you're really kind of stuck on this and you want this to work, you have to, like Dave's talking about, get to that path of confidence. And by doing that, you have to figure out and you've got to hack that. Why is it working now versus not working before, in a way that's not random? So, yeah, volatility or, the mood of the market or whatever it is.
Yeah, I think that, um, so a strategy like that, the one you described, I think that's the right way to approach it. If you really want to trade it, um, forward test it, trade it with small size, and see how it goes. I mean, that's another path to confidence. So
Hmm.
there's basically two paths to confidence. Just raw trading experience where you create a strategy in and out every day and come to know it and have experience with it. That's probably the most valuable. I
Yeah.
mean, it's definitely the most valuable.
The hardest to get though.
But that takes, yeah, it takes time.
Yeah.
It takes a long time. And a shortcut to that is back testing. Those are the two paths to confidence.
Hmm.
Um, and for something this short, what would happen what I can know what would happen if I started trading this. I would not I do not see a path to trading it with large size. I don't see that path. It's gonna take too long. Um, and so if a drawdown came, I wouldn't know. I would be looking back previous to this year and saying, well, there's no question. I mean, there's nothing that gives me the confidence to trade through that drawdown. So what I did with this trader said, all right, I understand you found something here. Let's find something that gives us a good equity curve for a longer period with this same strategy. And that's what we've done. So instead
Hmm.
of looking back to the beginning of the year, we've looked back to 2021. So we've got 4 years now, a completely different set of parameters to look at. Basically the same strategy, just taking a different combination of the trades. And it that and the fundamental reason why that's important is then you have that is enough period for me and for people I work with to get some confidence to actually trade it with size, to be able to trade through a big drawdown because or you're never 100% sure, and that's what makes trading so fun and
Hmm.
hard. You're never 100% sure, but you can have the confidence to trade with size and trade through a drawdown, and which is the hard part of trading, and that's the most fruitful part of trading, and that's what's going to keep you in the game longer if you're able to trade through drawdowns. Um, and like I said, the only way to do that is to believe in your strategy, and that takes time and effort to really truly do.
Yeah, and the another way to do it is just to look another way to look at it is just shelf it, right? You could take the strategy and say, okay, I may be onto something. Um, I'll see you in another 3 months or whatever it would take to go, and then work on additional strategies because it's funny. Every single one of these conversations generally comes back to you got to trade multiple strategies. It always comes back to that
Yeah,
because if you were if this was your first strategy and your only strategy, then there's a big psychological bias to hope that it works and to kind of force in your brain to say, no, I really did find something that didn't exist before and to push that going on. If you already have profitable strategies that you're running, it becomes much easier to say, oh, that's interesting. And then right, save it in a folder and set a reminder somewhere to come back to it in 3 months and if you are onto something, then the equity curve should look great, and then maybe that's a little bit more of the path to confidence. But unfortunately, all of this kind of stuff takes time again, unless you can replicate that. The other thing I was thinking while you were talking there about testing across like other markets, right? And again, you need to know more about the individual strategy, but it might be interesting to take that from the equity side of things and test it in I don't know, different markets out there like crypto
yeah,
or futures or something like that. And then if there's edge, because you can either go back in time or you can go wide across different
yeah,
instruments. And that's another way to do it as well, where I've taken strategies before where um, they work well in the futures market, but I don't have there's not enough securities in the futures market to make me really confident about it. So I expanded that market out to futures and then another whole bunch of liquid equities, because it is something that would really need that liquidity, and that gave me a lot of confidence with it to say, okay,
Yeah.
if I do it on Nvidia and Apple and like the most liquid names in the market by going kind of wide like that, that's another way to take a look at it as well, I think.
Yeah, totally. I mean, that's the perfect thing to do, and that should give you more confidence. Did you have to make any adjustments to make it work across all those instruments, or was it basically unchanged?
It's basically unchanged. The differences of the ticks or this how
Yeah,
futures trade versus that. But that was that was about it. And then I looked at the same, and what I did is I filtered out top S&P 500 names by volume, because again the whole point of this is it has to be very liquid for these indicators to calculate properly. But yeah, so going broad certainly helped with that. It still didn't it didn't do as much, I think, psychologically, as being able
yeah,
to see through different market periods and drawdowns as it did, but it was an okay kind of substitute. And what you may discover there is you may discover, because what I ended up doing, of course, the first thing was to go through the most liquid mega cap, billion shares a day traded names. But then you learn something about the strategy, because, of course, the next test is, okay, what about the next couple and the next couple? And then confirm that as you go down the liquidity and the volume scale, the system degrades. So sometimes, again, going broad gives you that, because at the end of the day, what I think we're looking for is just the most amount of data we can, right? And so we have to figure out different ways to try to get that data in some way, and then those are really the only two that I can kind of think of off the top of my head without
yeah.
looking
I,
for
I think I
ages.
think going broad is good, but I think going back in time further is even better because,
Yes.
and here's why. Um, basically, I'm lazy.
Good.
Laziness is a virtue. Like programmers like to say that, but
Yeah.
um, creating a strategy that you can have confidence in is hard. And
Hmm.
what I don't want to do is have to re-optimize and recreate, basically redo the strategy every 3 months. What I want to what I want to do, I'm trying to create strategies that work for a long time. So I don't have to
Yeah.
re-optimize and think about it, because you really it's deep thinking. You have to really concentrate. It requires a lot of focus.
Hmm.
And because you're answering questions like that, that you're convincing yourself, and the more skeptical you are, the better. You're convincing yourself that, hey, this is something that I'm willing to put money on the line for, and that takes time. So I don't want to be re-optimizing all the time. I've got one strategy that I've basically traded almost unchanged for like 15 years. And that that's long for my strategies, but I love it because I don't have to constantly. I mean, I look at it, re-optimize it every few years. I don't want to be doing this every few months, right? So
Yeah.
that's my goal when I create a strategy.
Well, and that's more important and compounded on, again, what seems to be the theme of most podcasts, which is multiple strategies. Very easy to do if you wanted to re-optimize a single strategy. You do that every week, if with time wise, if you really wanted to. But when you get five, six, seven, hopefully 10, 20 strategies down the road across different time frames and different market environments, and maybe different securities and all of that, it becomes a huge amount of work, right? And if you're taking 10 strategies and you're going have to go through and re-optimize them all the time, yeah, you're the amount of work and burden you're putting on yourself is just huge. Where if your reconciliation process that you do every day or every week or whatever it is ends up being that you don't have to do any of that, then that's great. Then you're reducing work, and that's kind of the point of systematic trading, right? Across other things, is that we talk about this all the time. You only have so much bandwidth throughout the day, and it should be spent on thinking of new strategies or improvement to existing strategies. It shouldn't be spent on just back testing and optimizing kind of over and over again.
Yeah. So if you're asking yourself this question about, okay, is 3 months good enough for this particular strategy? And this to provide a little more color here, this was a strategy that traded the NQ. So it's a futures
Hmm.
contract.
Yep.
Um, so really, what I'm in sort of reinforcing with this trader with Tyler is um, you need to be a little bit more paranoid. You need to be a little more skeptical about what the data is
Hmm.
telling you. So I've worked with some traders that we'll work on strategies, we'll come up with rules, and I'm guiding them so that they can come up with their own. That's a hard process, and it's one that I've gone through many times, so I can help people with their path to confidence. Um, One of the questions I ask them when they suggest a rule, or where they look at the data and say, "Okay, I think this rule is good." Um, I'm I asked them for, okay, what's the clear story? What's the coherent story that this rule is telling you? And imagine that imagine you're explaining this to a skeptical, experienced trader. Are they going to buy the coherent story you're coming up with about, okay, relative volume greater than X? That's a rule we should apply to the strategy because it improves it. Um,
Yeah.
Some of the traders I work with will I remember this one guy, not gonna mention his name. It was basically like he was, like, answering a test or something, like, checking the boxes, like, coming
Yeah.
up with just the most surface level story about why this rule would work. And I could tell, like, immediately looking at this, that he's not thinking deeply enough about it. You're not skeptical enough about it. You need to be thinking like what you said earlier. Why? Why does this work?
Hmm.
And imagine you're having to explain it to a skeptical trader and convince them. How are you going to convince them? Well, it needs to have some validity and not validity, and not just, hey, the data says to do this, so I believe it. Like it's got to be more than that.
Yeah, and it's the word skeptic, I think, has gotten, you know, bastardized a little bit recently, but that truly is it. Like, you should, and it's no different from any other scientific endeavor, right? You go in with the assumption of I have this hypothesis and I'm going to work damn hard to disprove it. And the way I look at it is the hypothesis is just the base strategy that, when XY happens, there's some sort of positive expected value. And you really need to spend a lot of time and energy trying to break it and see under what scenario it breaks. And I imagine, again, not a dev, that's a huge thing with software developers, right? It's like, here's my software, beat the hell out of it, and if it survives, then it's probably good, and it's probably good to ship out. And if it breaks, then okay, then we go back. That's a lot of the way that I look at building strategies. Is I don't want to prove to myself that the thing works. I want to try to disprove that it works, and by doing so, if it survives the test, then I know that I'm onto something. So, a lot of that could just mean robustness testing of, right? Say you've got like your RVol, right? If RVol 1 works, but then RVol 0.9, it just completely falls apart and it's garbage, then, it's doing this kind of stress testing and pushing on it from as many sides as you possibly can. And then if it survives that, then that really gives you that confidence to say, okay, this is something that I got to trade.
Yeah, the software development example is a good one. I think I remember multiple times shipping some software to you at Trade
Hmm.
Ideas, and then you would immediately break it. Like, well, it's just like as your developer, you go through and you can try to imagine what the user's going to do. As soon as it gets in the hands of a real user, like sometimes they do something that you would have never crossed your mind. So it's the
Well,
same way with the market, right?
yeah, we're seeing that a lot. I don't know if you saw the videos in self-driving cars now where people, like, a dude would just, for shits and giggles was walking down the street and he had a jacket on. Under the jacket, he had a stop sign on his shirt. You just open up his jacket and the cars would just grind to a halt. And it's a lot like that. We don't know what the future environment of the market's going to be. We don't know if this is going to be an incredibly volatile market or a dead market or an up market or down market. So what we need to do is we need to try to, and that's, I think, we keep coming back to, there's no substitute for a lot of data, because if you go back far enough, you've seen every kind of environment that there is. Um, and without that, right, again, it becomes really, really hard. So yeah, going into the process of, I'm going to break this thing. I'm going to prove to myself that it doesn't work, and then if it stands, then great. I think that's by far the best mentality to go to. I see too many people doing the opposite, where they're trying to make just the equity line point up,
Yeah,
and not understanding that you're just, you're torturing the data till it tells you whatever you want.
exactly. Yeah. So there's a really good quote by one of my favorite quotes by John Feynman, famous scientist from I think the 60s or 70s or 80s. Um, it's uh, something like uh, your goal is to not fool yourself, and you're the easiest person to fool.
Hmm. It's
So
it, it's one of those reasons why I can't do fundamental trading at all, or story trading, I think, as the kids are calling it, because I'm the kind of guy that I would listen to an earnings call, and all the BS that the CEO is always
yeah,
going to talk about how great everything is and how they're growing on all aspects. I go, this sounds really good. I'm going to hold on to that stock, and I can't do that because I would be too easily convinced, I think, by pretty words and whatever. And yeah, you can do the same thing with data. If it looks nice enough, you can convince yourself that you're onto something when you're really not.
yeah. There's I don't know if we talked about it on the podcast before, but there's this. So in economics and in other fields in the social sciences, there's uh, sort of a crisis because there's a lot of publication bias fields. So people, you see these studies like the marshmallow study from the 60s. It's hard to
Hmm.
recreate that, right? And uh, part of it is because there's this publication bias. Like people, you don't get articles published unless they say something that sounds cool, right? Or
Yeah.
sounds interesting and believable. So that's the incentive, is to say something good, no matter what the data really means, right? Or what the truth really is. Well, the one of the things I love about trading is there is no publication bias, right?
Hmm.
The only thing that matters is P&L, and you learn pretty quickly that there's no sense in fooling yourself. Like you have to really truly understand it to have a path to confidence to trade with size. And that's hard work. And when you're looking at the data, it's easy to be fooled, and that's the last thing you want to do.
Yeah, and I don't. That's why I always, the biggest thing to talk to someone it's like the end of the day, and I always say, would you put your grandma's money in this strategy, right? Because there's one thing to say, right? Oh yeah, I built this thing. I'll put my own money in it. But some people are flippant when it comes to their capital, and they're okay, maybe YOLOing or taking some risks. So I always go, okay, have you built this strategy in a way that you're okay putting your grandma's money in it? And then all of a sudden it's like a little stick up the butt there, a little, oh, okay. Well, then no, go back to it, right? If the strategy is good enough, you should be totally okay, putting, to get around all the, it's probably not good investment for your grandma to be day trading the market in her age. But yeah, if you wouldn't do it with someone else's money, if you wouldn't do it with something that's a little bit more risky, you could say their kids or something like that, then yeah, because your goal is to reach truth. And again, it's very easy to fool yourself with numbers and with data, but at the end of the day, hopefully you're going to load this into a robot, and that robot's going to do everything that this system tells it to do. And you're right, at the end of the day, you're either up money or you're down money, and doesn't matter what the equity curve said at that point. You can't eat an equity curve, right? You can only eat the money that comes out of the account. So
True. Yeah, that's good. So it reminds me of this, can't remember the site. We'll find it, put it in the show notes. It's basically a site that shows spurious correlations between different data
I
points.
love that. It's like the amount of what was it? The amount of gold medals won in the US versus like the amount of people who get choked by their own blankets at night or something. Like two things that make
Yeah.
absolutely no sense and they make the lines just perfectly right because there's all these yeah. I know which one you're talking about. I love that side. It's
Yeah, there's
hilarious.
tons of them, and it kinda brings it home, like, it's if you were just following the data, you would think a whole lot of things that just weren't true about the world by looking at that. So it definitely brings it home.
Well, and I think it also shows why there is it's very important to have some market understanding before you get into systematic trading. Not necessarily that you have to, discretionary trade for a long period of time, but some observation of the market or
Yeah,
some, like core fundamental reasons, because then if you do something like there's some people out there that legitimately wouldn't know that, the quarterly dividend growth of a company is going to work for a 5 minute scalping strategy. There's some people that really just wouldn't have
yeah,
that core understanding. So I always think it's like that. It's like the same as I wouldn't want to put somebody in the driver's seat of like a self-driving Tesla if they've never driven before because what if they needed to do something or what if I think you have to and it's one of the reasons and I know you're going to highly disagree with this but I keep my own discretionary trading account open and it's tiny and it's literally me just going through charts. I still like to do the macro analysis of the market and all that kind of stuff and I take these I force myself to take one bet a week just completely. I see this happening, this thing's breaking a trend line, just completely kind of discretionarily. And it's to kind of not ever get myself lost in the data. It pulls me back to what's moving the market is certain events that are happening out there. And I find it a good way to come up with new ideas as well, because sometimes you get a really good winner out of that. Natural gas was one that I had, for example, and the basic idea was it spent tons of time under the 200-day moving average and like 3 or 4 years, and then it finally broke through on like good volume and a good candle, and I bought some there, and I ended up making like 50% on the trade. It was an amazing trade. So that instantly your systematic brain goes, "Oh, well, let me go test that." Turns out it's not very good. But it's like one of those things that you have to be able to do that. But I think by grounding yourself in that or pulling yourself out of the numbers every now and then, I think is important. And again, I know you're probably not going to agree with it, but I think it's a good exercise to continue to have.
well, I think so. A couple things to say. One is I do see a lot of traders get stuck in I call it backtest world, where
Hmm.
they're not looking at the market, they're looking at a backtest. And
Right.
you're totally right that you need to watch things in real time and watch them play out. I don't think you need to necessarily just trade discretionarily, although you can. I think that's a great idea. Um, but you need to watch things in real time and see how they show up in the back test later to really kind of get a sense of what the market is and how it connects to your back test and what flaws the back tester has and
Yeah.
how to come to grips with that. But I will say I think you sort of underscored the whole point about confidence there because that the account you're trading, you said was small compared to
Hmm.
what you're doing with the other stuff, right?
Yeah.
It's because you
It's
don't have
playbook.
a path to confidence with that kind of strategy, and if you did, you would like it would take some work to trade something in the way you're doing there with a
Yes.
lot of size compared to the other stuff you're doing.
Yeah, because it's one of those, yeah, I can't test the hypothesis. It's just more of
Yeah.
having a feeling and wanting to take a trade off that. And I'm shocked that you said it was a good idea. I thought I was gonna get I was ready for
No,
the to get hit with a ruler or something. But
no,
yeah,
I
I
think
think
market intuition is really super important, and yeah, the more you can get of that, the better, and especially for systematic traders. I think that's very important. And, like, it's going to make you way better when you have the skills to backtest and you have the market intuition to
Mhm.
go with it. I think that's really powerful.
Well, and I think it should, if if we are talking to any discretionary traders out there right now, I think it also proves the path and the end goal should always be systematic trading, right? So every time I take a discretionary trade, if it ends up being a great trade, the first question I always ask myself is this something that I could then automate and test and go through that? And sometimes it's not. Sometimes it's just I know a geopolitical event's happening and a chart looks like X, and I take the trade and it does well. And yes, those are relegated to smaller accounts because that's kind of I look at those as flyers, right? They're not really going to be consistent, right? They're in the long run, that account does make money and it will make money, but it's just not something that it has too much to do with my brain and how I'm feeling and interpreting news and things that I can't quantify and put in a box and then, put
Yeah.
that box on the counter. So, but yeah, I do think there's some help there. And I also like what you said too about watching it live. And that's something that I think is very, very important where people, they want to set the bot, they want to go, do the beach or something every day. And I think you can do that sometimes, right? But I think it's important to have an exercise of, I'm going to watch a trade comes through. I'm going to click on the chart. I'm going to
Yeah.
watch the thing as it develops. And the beauty of it, it's not intense work because you're not doing anything. You're just watching. So, being able to put yourself kind of in an observer mindset, and have that detachment of, it's not my trading, it's this weird nebulous robot, even though I'm the one that made it.
Yeah.
Does a very good job of saying, okay, let me see what this does, and you can just kind of watch it detach. And again, it's really chill work. You could have a baseball game up or something on another monitor and be totally fine. But yeah, I do think watching the market day after day is very important because you never know where your ideas are going to come from.
Yeah. And there's some simulators you can do that sort of simulate that, but it's just not the same, right? You have to
No.
see it in real
No.
time and watch it play out.
Well, and with
Y
I think with the P&L associated to it, right? Because that makes it
Yeah,
way more engaging anyway. At least, at the very least, I would say a little bit around when the trade is entered and a little bit around where the trade is exited. If you have limited time, those are going to be the two most important parts. But I do think there's something to having it going and watching it anytime you can, right? I know a lot of people get into systematic trading because they have other jobs and careers, and that's fine, but as much as you possibly can, I think it's good to watch the trades play out.
100% true. Yep.
Cool. Well, I think we arrived at an answer. I think it was a roundabout way. With the basic answer was no, it's not enough data, but at least hopefully we gave you some suggestions on how to potentially deal with it. We came up with a bunch of them, right? From going broad to testing it small to right shelving it for a bit and bringing it back out. Lots of different ways to do it, but doesn't mean abandon it entirely if it's only working for that period of time. But like
You
anything, and
know,
this is yeah, go ahead.
I'll say one thing, but I just wanna make sure people are clear. Um, I'm not saying that 3 months is too short a time for any strategy. For this one, because it traded one instrument and the equity curve before that was
Mhm.
bad, that it then that by definition is not.
When I
So,
even
but
think
there's other strategies that have multiple equities where 3 months is actually plenty. So it all depends. There's no hard and fast rule that we're coming to here that people should take away from it.
right, and I think that the main, even for me, the main takeaway is the previous equity curve was bad, right? If you had no equity curve and you only had that 3 months period, that might be a little bit different. But the fact that you had way more evidence that the strategy didn't work than the strategy did work, right? Again, either you discovered something new or this is just like a glitch in the matrix and it's kind of working
Mm.
right now. So yeah, 100%.
Yeah.
But again, it's the thing I love about systematic trading is that. Um, some people would come in with a question like that and they'd expect a yes or no answer, and then we gave like seven different ways you can continue to test and ask more questions and dive into the
Yeah.
data deeper, and because we don't know, right? It could be that it could be a new phenomenon, it could be this, could be that, but the only way to know those things is again further testing, and it's funny, it ends up being I think the majority of answers is, I don't know, test it, right? I have
Yeah.
no idea, go back in. I think that's going to be the way to do it. For me personally, I think it would either, if I was very confident, I'm trading it small. If not, I'm shelving it and I'm checking on it and I'm setting a calendar, right? I'm going to my calendar and I'm scrolling a couple months away and I'm writing a note to say, hey, check back on this and see how it's doing. So I hope that helped. Do you have any other words of wisdom before we end it?
I think I think that's a good place to end it. The thing I'll underscore and what we said here about the path to confidence. It's not going to be the last time we mention that here because I think really trading fundamentally comes down to that,
Hmm.
and and that's why systematic trading is so enticing because you can get a path to confidence and you can get it quicker. You don't have to wait for years and years of trading experience to go by. It's sort of with back testing, it's kind of a shortcut to confidence. You can think about
Hmm.
it.
Well, awesome. Well, again, you can tell how much we appreciate comments and questions and all that kind of stuff because sometimes you stump us and we've got to come online to hammer it out. So I really enjoy these where it's not a predetermined answer, right? We have to kind of pound our heads to get together to get some ideas around it. So I really, really like that. So as always, I'm Michael Noss.
And I'm Dave May. Thanks for joining us. See you next week on Line Your Own Pockets.